our focus is really just keeping our eye on the ball. As the rules come down the pipeline, we need to evaluate how they apply to funds and other money managers, and then go from there as far as how we react to them. So that's very important because the whole class of traders and advisors are now going to have to work with the CFTC, the SEC, FINRA, and NFA to make sure that they're compliant with their reporting standards and to dive into a regulatory environment that they really haven't been a part of in the past. That's going to raise costs. That's going to raise an understanding of what the rules are. It's going to change the entire environment. Commodities traders, foreign currency traders that are OTC Forex, they're going to be paired and put with the CFTC, and they're developing requirements for funds that deal with swaps as well. And that part of it is still kind of a moving target area where things are really being developed and understood by the industry now. Conversely to that, on the security side, any securities-related products that you're advising, those would fall under the SEC and FINRA jurisdiction, and you'd have to look at those products independently and understand what your regulatory requirements were there. And also something to keep in mind is what your requirement to the state that you operate in is. Do you have to do you have to come under the advisory of the state regulatory commission? Do you have to work with state regulators in various areas that you offer your products or trading services? So there's a lot of different things and a lot of moving parts to look into. Previously, funds were able to register with the SEC if they had $25 million in assets or more. That threshold's been raised to $100 million in assets, and that will be the barrier to entry, so to speak, with SEC registration and oversight. What they've done is they've outsourced regulatory responsibility to each of the states for funds that have less than $100 million now, and the SEC and the federal regulators are looking more towards the larger managers. So the state requirements are going to be something that really are going to come into play, and people are going to have to work with in their own jurisdictions. There are some exemptions to registration for venture capital funds and foreign firms, but those exemptions are something that you're really going to have to look into and ensure that you qualify for, because there's a number of provisions and requirements that allow for those to be upheld, and you certainly don't want to make a mistake with which regulatory structure you have to fall under. Foreign advisors are going to be exempt for a number of different reasons if they qualify, of course. If they have 25 million or less in investor assets, if they have less than 15 participants, and if they have no location inside the United States that they're doing business. Now, firms that exceed those thresholds are going to have to seek independent counsel and determine what their regulatory requirements are, as the SEC is currently still working to determine what their reporting standards are going to be in the future. So a lot of the SEC's rules are kind of up in the air as to what may be required, but the hard and fast requirements that I just mentioned as far as the assets under management, the participants, and the location in the United States seem to be something that are solid at this point. Well, any advisor that comes under regulatory authority has to follow the authority of that particular regulator. So whether you're under the CFTC's jurisdiction or the SEC's jurisdiction or the state's jurisdiction, you're going to have to determine what their operational requirements are, what their reporting requirements are, and ultimately just what standards you have to adhere to on a monthly, annual, weekly basis, whatever period of time the reporting standard may be. So advisors that are coming under regulatory authority may have to put together standard operating procedures of different varieties that address certain areas of their business depending on whether they trade securities or commodities. They may have to file certain financial reports or different position reports with their regulator. They may also need to disclose certain information about how they trade, where they trade, what they trade. There's just a number and myriad of requirements that could apply. It's really important to read the rules and to understand, once you determine where you're going to register, what that regulator is looking for specifically, so that you don't make any missteps and aren't found to be irresponsible with your reporting requirements.